Hi, good morning. Today we'll learn short-term financing. Short-term financing. Yeah. Short-term financing. Companies need money for two reasons. Companies hold money for two reasons. One is the permanent capital purpose and temporary purpose. Okay. So this is temporary. This is permanent. So we need working capital here highest amount because our business is a seasonal business. Okay, here as well, highest amount. Here we can repay the amount back. Say for example, to meet this season, we buy the goods, on credit, we sell them off, we collect money when we pay here. We don't need to pay interest once you pay. Then you have to buy here, borrow money here to buy the goods, sell here, and pay them back. So this is where you need temporary working capital. And here this is for day-to-day requirement without any hassles, like it's fixed amounts like what rent, payroll, office expenses, sales commissions, etc., etc. These are all expected, and usually they are incurred evenly each month. Evenly in a sense, for example, our company routine expenses are of 1 million. So each month, whether it is Jan, Feb, or March, or whatever, you need plus or minus 1.5 million. But here you need to buy an inventory at high levels to meet this seasonality. So you'll have to buy heavy inventory, and you need to pay the suppliers commissions, heavy salaries, overtime, utilities, etc. So you need some extra capital, which is called temporary working capital. Now we are today discussing on short-term financing. A borrowing for a period of 1 year or less is called short-term financing. Short-term financing portion you can see on the current liabilities of the balance sheet. Current liabilities. These current liabilities include your accounts payable, which is a credit purchase. We call it a sundry creditor. Accounts payable, notes payable. The difference between accounts payable and notes payable is accounts payable means open account, means just an oral promise that we buy goods worth 5 million. We know the supplier has trust on us, so we just buy, sell the goods, pay him back. That's it. It's an open account, means no written promise. But if any supplier from whom you purchase recently, before that there is no relationship, then obviously he will ask you to produce some written promise. It can be a promissory note, a post-dated check, or a time draft. So these amounts which you give instruments, these amounts which are paid by the instruments are called as notes payable, written promises. Both are sundry creditors, both are current liabilities. But an open account is called accounts payable, a written promise is called as notes payable. Both are to be paid in a short period of time, maximum period within a year. Accounts payable. Accounts payable is a sundry creditor balance which forms due to the credit purchase. In most of the industries, especially retail industries, the accounts payable play a key role. If you see the long-term liabilities, the owner's equity, etc., the accounts payable will be the portion of accounts payable will be higher. This is called as spontaneous credit. Accounts payable is called spontaneous credit. Means hassle free. As long as you maintain the good relationship with the supplier, paying the supplier on time, maintaining the good relationship, meeting the standards will create a reputation, and you keep purchasing from him on regularly. Therefore, the spontaneous credit will be formed. Like when you go to a bank to borrow, if some money for a period of say 3 to 6 months, there are lots of rules, regulations, formalities need to be followed. But in the case of accounts payable, it is not like that. It is a spontaneous credit. A spontaneous credit example is accounts payable and trade credit. Trade credit. The short-term financing. The sources of short-term financing include short-term spontaneous financing, any negotiated financing like accounts payable becomes notes payable, etc. Factoring of receivables, which means you have receivables, and these invoices will be the receivable invoices will be means sundry debtors invoices will be okay pledged to a bank, and we get some money. Say for example, you have a receivable of 1 million which can be collected after 4 months from now, but you need money now. So you can factor these receivables with any bank. Bank may say that we'll give you 80% of the 1 million, that is 800,000, with an interest of say 6%. So for 4 months you can get finance from the bank. 4 months you can get interest from the bank, or sorry, loan from the bank. You need to pay just interest. Yeah. So accounts factoring of accounts receivable, composition of short-term financing like bank overdraft, short-term loans, etc. One second, please. Yep. So composition of short-term financing, which include bank overdraft, bank overdraft, short-term loans. Okay, like different types of loans we have, short-term loans, etc. Types of spontaneous financing include accounts payable, wherein you don't need to fill lots of formalities, just you maintain the relationship with the supplier, good relationship with the supplier by paying them on time, giving assurance that they will get money. Okay, it is called spontaneous finance or trade credit. Accrued expenses, the outstanding expenses also are finance, because we don't need to pay interest. If you just deter your expenses for some time, that itself is a finance. Say trade credit examples include open accounts, which are oral promises as we discussed, and notes payable, written promises. Trade acceptances, the drafts. So we call it as bill of exchange. A draft is a bill of exchange wherein when you buy the goods, when you buy the goods, you need to accept a draft which is drawn by the drawer. Drawee signs the bill and sends it back to the drawer. So upon the due date, drawer presents the bill and will get the money. So a draft is nothing but a bill of exchange. It becomes a bills payable for us. Okay, or a trade acceptance in which the settlement is done through a draft. Draft in our terms, it is a bill of exchange. Cash on delivery, cash before delivery. Here in this case, no credit, no trade credit, and this is not our topic. In fact, we are talking about the short-term financing. If at all the sale terms include COD or CBD, which means you need to arrange cash from the bank. We'll be using this EOD or CBD only when there is a huge discount at the time of purchase. Say a product can be purchased at $10, but the supplier says that if you pay me cash before the delivery, I'll supply you at 9.5 itself. So to avail this, we may borrow money from banks. So in that case, you need to see what is the cost of borrowing and what is the benefit of this discount. Compare and take decision. Compare and take the decision. Cost of borrowing is lower than the discount what we get. No, then you can go ahead. Net period, no cash discount. This is one of the important topics what we are going to work on is net period and no discount. Net period means your supplier gives the customer a period time, like today you purchase the invoice value say 1 million and net period of 30 days, means you can pay any day before 30 days with no discount. That's called net period. Net period, in short term we use net and followed by days. So any invoice which comes with net 30 or net 40 or net some days means that within those days you have to clear your invoice, and full invoice, 100% invoice. Yep. So here two terms here: cash on delivery, cash before delivery. Cash on delivery means at the time of delivery you need to surrender the cash, so it is pure 100% exchange at the time of receiving the goods. Cash before delivery means you pay first, then wait for the goods to come. Cash before delivery. You will pay cash on delivery or cash before delivery only when there is a huge discount. That's called purchase discount. Say, for example, you do not pay, you wait for 1 month. Okay, your supplier will wait for 1 month and you have to pay $10 per unit. He gives you an offer, either you pay cash on delivery or cash before delivery. The price will be $9.5 per unit. If you feel that, why don't we avail this discount, and you are running short of money, obviously you should approach the banker. Then you should see the cost of borrowing and the benefit of the discount. Compare these two. If the benefit what we receive is greater than the cost of borrowing, go ahead with. Else, tell the supplier that I will pay you only on due date. So you'll have to pay this much. That is called net period. Net period means a credit period given by the supplier with no discount option. Say for example, 8th of January you purchased with a net period of 30 days. So it is the term used for net period is net followed by the number of days. It means that you'll have to pay full payment if you pay any day up to 30 days from the date of invoice. Net period, no discount period. Okay, so whenever you see any invoice net 30, net 40, net followed by days, means within these days you can pay, but no discount would be offered. Net period with cash discount. In that case, you will have a prefix. You will have a prefix to the net period. Say for example, here 2 of 10 net 30, which means 2% discount will be given if you clear the bill within 10 days from the invoice date. Listen carefully. You purchased on say 8th of January, and before 18th if you pay this amount, any invoice amount, you'll have to pay only $98 for every $100. That is 2% discount. So you borrow money from bank 9,800, to clear an invoice value of 10,000. See that what is the borrowing cost of this 9,800 and whether the borrowing cost of 9,800 is less than this $200 discount you get or not. Say the borrowing cost is, say for example, with X percentage of interest, it is $120. You pay $120 cost of interest on borrowing and you avail a discount of $200. Yeah, go ahead. This is called cost of not taking the discount. Cost of not taking discount is $80. $200, $200 is a benefit. $120 is the cost. So benefit $200, cost $120, net benefit is $80. If you don't borrow and avail the discount, cost of not getting discount is $80. And here our calculation will be like this: 2 of 10, net 30. Here 2 means discount rate. 2 is called discount rate. Okay. 10 means discount period. And 30 is net period, where there is no discount at all. So here from the invoice date you have 10 days. After the discount period you have 20 days. The total days are 30 days. Okay, so this is a discount period and the remaining is called net period, no discount period. This is no discount period. Total credit given by your supplier is 30 days. Within that you have discount period 10 days. Okay, and non-discount period 20 days. Therefore it will become 10 plus 20, 30 days. So your supplier is giving you for the payment in advance for 20 days. Actually you can clear the invoice in 30 days with no discount. But if you clear within 10 days, there will be a discount of 2%. So your supplier is losing 2% for getting this money 20 days in advance. Instead of getting 30th day, supplier is getting 10th day. Means 20 days in advance he is getting. For 20 days in advance, he is losing 2%. So the interest for 20 days is 2%. What is the interest for yearly? That is 360 days. So 2% into 365 divided by 20 will give you annualized discount, annualized interest. For this we use a formula here. The cost of not taking discount equals to 2 divided by, you will be paying only $98. Therefore 100 minus 2, 2 divided by 100 minus 2 multiplied by year. You may take 365 or 360 depending upon the question, divided by net period minus discount period, because for getting this 20 days in advance we are getting 2% discount. So 2 divided by 98 times 365 over 20 will give you around 24.49% approx. So the annualized amount is 24.49. This is per annum. So the formula will be simple: discount rate divided by 100 minus discount rate multiplied by 360 or 365, please. This is subject to the question. If the question is silent about number of days in a year, take 365 days divided by NP, that is net period minus discount period. This will give you cost of not taking the discount. If you want in percentage, you can multiply with 100. Yeah. So now we understand how to calculate the cost of not taking a discount, with this formula, dr discount rate divided by, okay, 100 minus dr times 365 or 360 divided by net period minus the discount period multiplied by 100. Use my technique just now what I explained you rather than using the formula, because you'll be getting approximate answer within no time. Seasonal dating. Seasonal dating. Sometimes what happens is the suppliers induce the buyers before the season comes. You buy better here. So the manufacturers produce the goods here, expecting the season, and ask them to buy here to meet the seasonality, like fireworks. They are manufactured off the season, and dealers they buy during the season or before the season entire product. Once they sell, they will pay it back. Or the customers may finance pay them that to procure the raw material and all produce, and the manufacturers will produce, then sell at a discounted price to customers. That's called seasonal discounting. Means before the season begins, the manufacturers will manufacture the goods by either getting amount well in advance from the customer, or they finance to the customer. There's a small question here. What happens to the accounts payable if a firm purchases $10,000 at a net 30? So net 30 means on 30th day, if you pay, there will be $1,000. Okay. And if it is a daily purchase, it will be 1000 times 30, it is 30,000 balance. Okay. If the firm purchases 1500 per day for net 30, the accounts payable will be 45,000. So you will have to hold this accounts payable in your books for a period of 30 days. For a period of 30 days. On the other side, supplier will keep accounts receivable for a period of 30 days. So it's a investment outside with no interest. Okay, this is a formula just now we practiced, and you don't need to work on it by using the shortcut. Okay, see, almost 37.2, because it's 2% for how many days? 20 days. Stretching the payables. How do you stretch the payables? Means delay in the payments. Delay in the payments will help us to save the interest cost. Else, if at all the cost of borrowing is cheaper, pay and avail the discount. And if you don't pay on time, delaying the payments for long period, the supplier may charge you interest. Therefore, you need to have a good support from the banks to pay the supplier on time or to avail the discount. Otherwise, it will spoil our reputation, and the rating of our company may go down. The advantages of having trade credit, as we discussed, that there are no formalities like when we borrow from bank. So it's a just spontaneous credit built up based on the mutual trust. Very convenient, because at a phone call you will get the goods. You will have a greater flexibility. Okay, it's like a day to day finance. It's not like a borrowing from bank for a stipulated period of time, etc. The spontaneous credit or usually interest free credit, which is called trade credit, provided by the suppliers. The other one, where the no need to pay interest in the balance sheet, the expenses which are unpaid. Examples are the utility expenses, unpaid wages, any interest amount, dividends, etc. Here, spontaneous finance. We want a kind of finance where it can be borrowed on daily basis or weekly basis or for a month. So that is called negotiated financing. A negotiated financing can be money market credit, which is borrowed on short period. Examples include commercial paper. Commercial paper is a promissory note issued by public limited companies to the individuals or other companies for a period 30 days to 270 days. So within these days you'll have to repay. So say for example my company wants a 3 million cash. So this 3 million cash is broken down into $1,000 each. 3 million divided by 1,000. So 3,000 commercial paper, these promissory notes will be sold to public. We pay interest on them and will repay them in a maximum period of 270 days. Bankers acceptances, these are the acceptances given by the banker, which can be which can be submitted to the
Sir,
supplier.
Commercial paper like that.
Okay, so the next one is bankers acceptance. This is a facility given by our bank. Say for example, I want to pay my supplier after 60 days from now, but supplier doesn't believe us. I don't have money, I want goods. So to make him agree, what I do is I request my banker, like say Standard Chartered Bank, to issue an acceptance. This acceptance is submitted to the banker. In other words, it is like a PDC, post dated check. But if you give post dated check from your company, he may not trust till that. What happens if you when he deposits, you don't have money in the book in the bank. Instead of that, bank gives an assurance that yes, this gentleman will pay you. That's called banker's acceptance. This gentleman will pay you on 60th day from now. So you are getting a credit period for some period, some short period of time. Unsecured loans like line of credit. Line of credit means the credits given by the bank. Line of credit means the credits given by bank. Credit means the loans. Like revolving credit. Revolving credit means a bank gives you say $500,000 loan for 3 months. January 1st was the loan. This loan is to be renewed on 4th of April or 1st of April. 1st of April means this $500,000 was credited into your account on January 1st. You need make sure that you need to have 500,000 plus interest on 500,000 on 1st of April. The banker sees that whether this balance is there or not. That particular loan account 12457 is the loan account number. It was minus 500,000. They gave you loan. Plus they will take back this 500,000, make it zero, and same day or next day they will renew the loan. Again they will give you 500,000. This money should be there as on that date. That make sure that next day or same day they will renew your loan and give you back. This is called revolving credit. Revolving credit. Revolving credit is a part of line of credit. In line of credit, in a sense, you have lots of different types of loans like overdraft facility, short-term loans, trust receipts, etc., etc. A revolving credit means it is going to be renewed as and when the time period expires, and you make sure that you maintain that amount that would be adjusted against the loan and will be given a new loan. Transaction loan means whenever you purchase, there will be a loan. When you purchase the goods on supplier or from supplier on credit, your supplier will be paid by the bank, but you need to clear it off once you sell the goods. Say for example, you purchased inventory worth one truck of 1.2 million. This 1.2 million worth of goods are hypothecated to the bank. So the bank will have complete power on this. Why? Bank has paid to your supplier. So this hypothecation can be relieved only when you sell this inventory and pay the money to the bank. You sold this inventory for 1.5 million. From this money, clear off this 1.2, which is financed by bank. So these are all unsecured but subject to the banks. We cannot say fully unsecured. Okay, commercial paper. LC, letter of credit. What is letter of credit? It is a kind of promise given by the bank to the supplier's bank stating that we are assuring the payment of your customers payment. Let me give an example. Say for example, one customer is in India, met a supplier who is from China. China is an exporter. This Indian is an importer. Say for example, if the importer says that you send me goods, I will sell them back and then later I'll pay you cash. The supplier says that no, I can't trust you. Do one thing, you send me full amount, I'll produce the goods and dispatch you. No, Indians will say, no, it's not possible. I don't trust you. So there is no mutual trust between them. In that case, the Indian customer who is an importer will approach his bank, say Standard Chartered Bank in India, to give assurance to the exporter's bank, which he mentioned, HSBC in China. Okay, he gives the bank details to Indian importer saying that, okay, you do one thing, you don't trust me, I don't trust you. Do one thing, ask your banker to give some assurance to my bank. These are my bank details. You ask your banker to give assurance to my bank. Oh, okay, that's fine. So the importer in India will approach his bank requesting giving assurance of the payment to the supplier's bank. Upon receiving this assurance from Indian customer, HSBC will notify the supplier in China. So once he receives the notification, supplier receives the notifications from HSBC, he will start producing the goods. He will produce the goods and sends them to India, but the original documents, the ownership documents will be sent to HSBC. HSBC will send the documents to SCB. Then SCB will notify the importer that the documents have come from China. You please come and pay and clear your documents. This is called letter of credit. LC is a promise given by the importer's bank to the exporter's bank, giving assurance for the credit created between the importer and exporter. Banker's acceptance is nothing but a promissory note given by the bank for a future date to the supplier. Same like LC. Unsecured loans, various unsecured loans, short-term loans given by the banks for against security, it is secured loan. With no security, no pledge, it is unsecured. Line of credit, so many different types of other loans given to the customer or line of credits. Unsecured loans like revolving credit agreement, which I just explained to you. Now commitment fee, whether it is a secured loan, unsecured loan, revolving credit, whatever, bank charges some amount. Say for example, you borrowed 100,000. The bank may use any term like documentation fee or processing fee or commitment fee or flotation cost like 2%. So when 2% is reduced here, you will get only 99,800. The net proceeds will be 99,800. And this loan is borrowed at the rate of say 8%. You receive 99,800, but you'll have to pay interest on 100,000. Okay. So a commitment fee is an amount charged by the financial institution for giving a credit. Transaction loan, any kind of transactions like purchases, manufacturing, etc. the financial institutions give loans. Interest rates. Interest rates are of two types, prime rate and nominal rate. Prime rate means which is the lowest possible rate given to only VVIPs. How do they become VVIPs? Because their credit worthiness is too good. Their rating is too good. Like CRISIL in India, Standard Poor, okay, Fitch, Nasdaq. These people give rating based on the defaultness of the clients. Their financials are good, the reputation is good, company is doing well. Then companies will get triple A plus plus plus. Such companies get lowest interest rates from the banks when they borrow from banks. So that's called interest rate, prime rate. Whereas the other companies who are not into credit worthy, they may get at high rates. So nominal rate, which we call it as stated rate. Stated rate. So here we borrow 10% on 100,000, 10% on 100,000, it is okay, $10,000. $10,000, if $10,000 is given, loan amount is given, it will be 10%. But you discount the loan. Discount the loan. Discounting the loan means interest is received by the financial institution upfront. In the previous case here, bank gives $100,000. You carry $100,000 to your business. You can invest this entire $100,000 in your business, wait for 1 year, come back, pay $100,000 plus $10,000 towards interest. So total disbursement after 1 year will be 110,000. So this is interest. This is towards principal. So here your rate of interest is only 10% because you are paying at the end of the year 10,000 extra. But in the case of discounting the loan, it is different. The financial institution grants you a loan of 100,000 at the rate of 10%, but there is a clause that the loan is a discounted loan. What does it mean? The amount of interest is deducted upfront. Upfront means at the time of dispersal of the loan itself. So you will utilize in your business only 90,000. Though you borrow 100,000, interest is already deducted at the time of dispersal of loan, and you can use only 90,000 in your business. But what is the amount of interest you are paying? 10,000. On how much amount utilized in your business? 90,000. So the rate of interest is not 10%, it is going to be 11.11%. Here this 10% is called as stated rate of interest. What is it called as? Stated rate of interest. This is there in your agreement. Rate of interest is 10% and the loan is discounted. Loan is discounted means you will get net proceeds of only 90,000. In that case, your rate of interest will not be 10%, it is going to be effective rate of interest. Effective rate of interest is 11.11%. So please, you should, when your loan is discounted, don't call your interest cost is 10%. Your interest cost is 11.11%. Say for example, your target is earning of 15% using these funds, and if you think that your cost is 10% and you are targeting 15% and you will earn a 5% net profit, no, it is going to be only 3.9 or 4.9, 4.89. Why? Because here 15% is okay, fine, but 11 point, no, it is only 3.89. 11.11 is effective rate of interest because you are using only 90,000 in the business. So do not do all these calculations and waste your time in the exam, please. So for discounting loan, you can write a formula: stated rate of interest divided by 100 minus stated rate of interest. That's it. No need to calculate the amounts. Just you can use this formula. What is that? 10 divided by 100 minus 10 will give you 11.11%. You don't care about the amounts, please. In the exam also, he may give you lots of bigger amounts. No, just take only the percentage. Stated rate of interest divided by 100 minus stated rate of interest into 100. If, again, you can write one more formula. If the loan is discounted and there is some cost also, like here, some cost is deducted, what is that? The commitment fee. Interest is discounted and there is a commitment fee as well. Say for example, 10% is the interest, commitment fee is 10% or 2%. In that case, stated rate of interest divided by 100 minus stated rate of interest minus the commitment fee into 100. Here the amount will be stated rate of interest. What is that? 10% divided by 100 minus 10% minus 2%. Yeah, so it is going to be 10 divided by 88 times 100, 11.36. See, the rate is increasing. Let me show you whether it is right or not with amounts, but don't do with amounts, please. It will be time consuming. So you know that interest is 10,000. See, 10% on this, and you know that the commitment fees is 2%, which is 2,000. So the total cost of this loan is 12,000. So after deducting, this is a discounted loan, right? So after deducting this amount from 100,000, your net amount received is going to be only how much? 88,000. So the rate of interest is 10,000 divided by 88,000. You will carry home only 88,000 after deducting 12,000 times 100. Calculate now. 10 divided by 88,000. 10,000 divided by 88,000 into 100 will give you same rate again, 11.36. What I mean to say is, don't waste your time by calculating the amounts. Use only the numbers here, numerics. Do not calculate the amounts. Okay. Compensating balance. Compensating balance is the amount which is held by the financial institutions for various services which are provided by the financial institutions. That can be a loan, that can be a current account, that can be a overdraft facility, whatever. Compensatory balance has to be kept with the bank only, like how we maintain a minimum balance to have a checkbook in the bank account. So, same way, when you borrow money, the banker may ask you to keep some amount aside. So, here you borrow $50,000. $50,000, $50,000. Rate of interest is 10%. Rate of interest is 10%, and the balance, compensating balance, is 20%. Okay. Say now compensatory balance means 20% of this 50,000. The 10,000 will be kept aside. This 10,000 will be kept aside. Means bank will say that we are giving you a loan of 50,000, but we keep 10,000 with us only. You take home only 40,000. This is called compensatory balance. On this, most of the banks do not pay you interest, but interest will be charged on the total amount. So how much interest you are paying here? 10,000. On how much balance you used in the business? 40,000. So the rate of interest will be different now. Okay, 10,000 divided by 40,000 times 100 is going to be, what is that? 25%. Yeah, 25%. 10,000, 10,000. No, not the 10,000 is not the interest, sorry. 5,000. 10% of 5, 50,000. 5,000 divided by 40,000 is going to be 12.5%. See, your cost is increasing. It is though on the paper with an agreement with the bank is only 10%, but effectively it is 12.5%. And again, please do not do this calculation with the amounts. Don't waste your time. The formula with the compensatory balance is interest, stated rate of interest divided by 100 minus percentage CB. Okay, let me give you this. We borrowed 150,000 at the rate of 10%. Sorry, we borrowed 1 million at the rate of 10% with a compensatory balance of 150,000. 150,000 is nothing but 15%. This is 15%. 15%. So what you need to do is 10% is the rate of interest divided by 100 minus 15%. See, calculate 10 divided by 85. 10 divided by 85, which is 11.46. So you will get 0.76 like this, or you can write 11.76. So better you write into 100. So write a formula. The effective rate of interest in case of compensatory balance equals to stated rate of interest divided by 100 minus percentage CB. Listen again. Even if you at this point also, if you have any commitment fee minus percent commitment fee, you can write like this, then into 100. In this exercise, this is 0, no problem. There's no commitment fee here. But if at all, if the commitment fee is also there besides compensating balance, so in that case, stated rate of interest divided by 100 minus percentage CB minus percentage commitment fee into 100. This will give you effective rate of interest.